Cisco Systems trades at $77 with a massive $308 billion market cap, and 17 analysts give it a buy rating with an $84 price target. That's an 8% upside potential. But is this networking giant really worth your investment? Let's break down the numbers that matter. The valuation story shows Cisco trading at a P/E ratio of 30.11, which drops to just 18.59 on forward earnings, meaning the market expects strong growth ahead. With a PEG ratio of 1.94, the stock isn't exactly cheap, but here's what makes it interesting. Revenue hit $57.70 billion with a profit margin of 17.90%, and the company generated $12.73 billion in free cash flow. That's serious cash generation power, and they're returning it to shareholders with a 2.10% dividend yield plus a 1.25% buyback yield, giving you a total shareholder yield of 3.35%. Cisco's positioning in the AI infrastructure boom is the real catalyst here. The company just launched next-generation switches with tenfold performance improvements specifically designed for AI networks, targeting the massive data center build-out happening globally. Product orders jumped 13% with cloud and service provider orders surging over 40%, and management guided fiscal year 2026 revenue to $60.6 billion. That's 7% growth, with EPS exceeding 4.10. The networking segment alone generated $7.8 billion, up 15% year over year, driven by AI and data center demand. Now let's talk risk management. Cisco has a debt-to-equity ratio of 0.63 and generates enough cash to cover interest payments 8.52 times over, showing solid financial health. Return on equity stands at 22.42%, proving management efficiently uses shareholder money. However, the current ratio of 0.93 and negative net cash position of negative $13.90 billion need attention, though the strong operating cash flow of $13.74 billion provides a safety cushion. With institutions owning 78.60% of shares and the Altman Z-score at 2.83, just below the safe zone of 3, there's moderate bankruptcy risk worth monitoring. The bottom line, Cisco offers a rare combination of value tech exposure to the AI infrastructure boom without the sky-high multiples of pure AI plays. You're buying steady earnings growth, a 2.10% dividend that's grown for 15 consecutive years, and exposure to multi-year data center expansion. With analysts targeting $84 and current technicals suggesting accumulation between $70 to $68 with targets at $85, the risk-reward setup favors patient investors. This isn't a moonshot play. It's a cash-rich, shareholder-friendly way to participate in AI networking infrastructure while getting paid to wait. The company's 64.85% gross margin and consistent free cash flow generation make it a core holding for tech portfolios seeking stability with growth potential.